The fundamental issue with the United States lies in two words: the economy. After reading this, you'll understand the real logic behind it. A recent hot topic is the continuous rise in the long-term interest rates of U.S. government bonds, which seem to be approaching 5%. Although there were minor adjustments on Wednesday and Thursday, the 10-year bond still remains above 4.7%, maintaining a 16-year high. So, what's the impact of this? What's the reason behind it? Firstly, why is this happening? Because the bond sell-off leads to a decrease in prices, leading to continuously rising interest rates. So, the interest rate is inversely related to the price. And the recent sell-off of U.S. long-term bonds has caused the interest rates to rise. So, the higher the interest rate, the more the bond price has fallen. If you held a 10-year bond since 2020, based on the current price, it has plummeted by 53%. If it's a 30-year bond, it's dropped by 40%. If you don't want to lose your principal, you'd need to hold it until maturity. Then, each year, the interest rate you would enjoy is only about 1% to 2%. Thus, the intense fluctuations during this period are particularly noteworthy. Behind this fluctuation is the investment world's self-protective reaction to the unsustainability of the U.S. fiscal policy and enormous debt. Only by understanding this factor can you comprehend why previously stable bonds have fallen so much. In fact, anyone can see that such a rapid rise in interest rates is very unusual. Because the Fed has already indicated, either explicitly or implicitly, that their interest rate cycle has reached its end. Yet, the interest rate is still rising, which is very unusual. The factors affecting price and interest rate changes in the U.S. or global bond market are not just inflation and monetary policy. Many people have overlooked a very important issue, which hasn't been seriously considered in the last 100 years. That is the supply and demand issue of U.S. debt. If something goes wrong, what would the scenario look like? Supply means the U.S. continues to issue debt, and demand is how many people want to buy this debt. This is the supply and demand in the U.S. bond market. So, what determines the price and interest rate changes isn't just inflation or just the Fed's monetary policy. Supply and demand also play a crucial role. If a large amount of government bonds is issued, but not many people want them, how could the price not drop? This goes back to the long-ignored U.S. fiscal deficit issue. How severe has it become? Remember, in the 1980s, the U.S. cared very much about the fiscal deficit and trade deficit, the twin deficits. Back then, the U.S. national debt was less than 60% of GDP. Even so, they were very anxious. But in the early 21st century, a notion emerged, basically suggesting that no matter how much debt was issued, there wouldn't be inflation problems or unsustainable debt. So, for the greater good of the people and increasing welfare, U.S. began the so-called issuing as much debt as possible. If you've read financial journals or books about the U.S. around 2010, you'd have seen many statements arguing that we shouldn't worry about the deficit anymore. Just issue debt, and it can solve many of U.S. economic problems. So, the prevailing thought trended towards believing deficits weren't a major concern. As a result, debt accumulated rapidly. After the dot-com bubble in 2000, the 2008 financial crisis, and the 2020 pandemic, the response was to keep cutting interest rates. After 2018, there was even quantitative easing, QE. By 2020, it was unlimited QE. Every time there was an economic issue, U.S. response was to keep easing. Easing again and again. Coupled with the loose fiscal policy in the U.S. kept issuing bonds. Then, the Federal Reserve would buy back these bonds and release the money. This was a key means to maintain their economic prosperity. So, the question arises, can such a fiscal operation truly last in the long run? Thus, by the end of 2021, inflation really began to emerge. U.S. inflation wasn't just because of the Russia-Ukraine issue. Remember, the Russia-Ukraine issue only emerged in 2022. But by the end of 2021, U.S. inflation was already evident. When printing money reached a certain level, and globalization was inevitable, the cost reductions and low prices from 40 years of globalization became unsustainable. The unsustainability of the U.S.'s low interest rate has raised concerns. When the era of high interest rates arrives, the fiscal and debt situation in the U.S. becomes unsustainable. This is the result of a domino effect. However, neither Europe, the U.S., nor, in fact, the entire world has truly experienced such a scenario in the past century. Hence, it's uncertain what lies ahead. What's even more concerning is that this is just the beginning. Let's delve deeper into the unsustainability of U.S. finances. Short-term U.S. debt, maturing in 1 year, constitutes about 20% of their $33 trillion debt. Medium to long-term debt, such as bonds maturing in 5, 7, 10, 20, or 30 years, makes up about 65% of the total debt. Floating rate bonds, which fall between short and long term, account for approximately 15%. From 2020 to 2021, the issued rates were exceptionally low, ranging from 1% to 3%. But now, most interest rates hover around 5% or even higher. Whether it's 3-month, 6-month, 1-year, or 2-year bonds, all exceed 5%. 10-year bonds are at 4.7%, 20-year bonds surpass 5%, and 30-year bonds sit at 4.8%. Despite these rates, the annual budget still sees expenditures exceeding revenues. The current fiscal deficit is estimated to be $2.2 trillion annually. Borrowing at newer, higher interest rates is necessary, meaning high-interest loans are taken out to service low-interest debts. The financial impact of this is concerning. Regarding medium to long-term bonds, from the beginning of this year to the second quarter of 2025, the volume of U.S. debt maturing exceeds $650 billion. Thus, at least $650 billion of new debt needs to be issued every quarter to refinance the old debt. This means the U.S.'s interest expenses will skyrocket in the coming period, especially considering the addition of the annual $2.2 trillion deficit. Based on the interest payments made in the second quarter, annual interest alone, excluding principal payments, amounts to over $960 billion. As interest rates for subsequent quarters are set to rise from 3% to 5%, this amount will substantially increase. Many predict that next year, the U.S.'s interest expenses will exceed $1 trillion. According to U.S. budget forecasts, by 2026 or 2027, yearly debt interest could reach $2 trillion. To put that into perspective, the total U.S. tax revenue is around $4.9 trillion annually. This means current interest payments account for about 20% of total revenue. If this reaches $2 trillion, it would constitute 40% of total revenue. These figures are based on the 2022 fiscal year, a year when tax revenues are not increasing, leading to significant supply and demand challenges. Who will buy these bonds? The Federal Reserve, shifting towards quantitative tightening, is no longer purchasing bonds. Instead, it's ending $950 billion worth of maturing bonds and derivative securities each month. Rather than being buyers, they now lean towards being sellers. How about foreign central banks? Most are predominantly selling or, at best, buying minimally. Their potential purchases are limited, and their books show significant unrealized losses. Do domestic big banks buy U.S. bonds? They too face the same problem, significant unrealized losses on their balance sheets. Although they can hold these bonds until maturity, any forced sales will realize these losses. This very problem has hit Silicon Valley banks this year. Adding to this, the international retirement funds responsible for the UK's financial issues and insurance companies worldwide show balance sheets riddled with losses from long-term bonds. Many were unaware of the potential magnitude of these losses. Most operators haven't seen such scenarios since the 1980s. The shock this brings to the global financial system is immense, elevating the risks among financial institutions. Corporate financing costs are surging, and private consumer loan and credit card costs are also on the rise. These are the tangible impacts on the economy. How can this problem of rising interest rates be resolved? Most reports suggest that a significant economic downturn might be the solution. However, this isn't a preferable outcome, as it would drag the entire world down with it. The U.S. must face and address this issue sooner or later. Perhaps the next 1 or 2 generations might bear the cost.